Warriors of price action and guardians of fundamentals, welcome to Retail Recon. On today's Recon Reports episode, we're doing a full tactical debrief on Qualcomm, QCOM, a trade where the thesis, the timing and the setup aligned almost perfectly. This is one of the cleaner, more satisfying trades so far. Direction, entry and risk control all came together. Of course, no trade is truly perfect, but overall, I'm very happy with how it played out. So gear up and let's walk through this mission. The plan. Qualcomm first caught my eye because it was behaving very differently from its semiconductor peers. While the other chip names had already rocketed higher, QCOM looked like it was being left behind, stuck near the bottom. At that point, the stock was trading below both the 22 EMA and the 150 EMA, which reinforced the idea that it was underowned and oversold. My thesis was simple. QCOM would eventually catch up to its peers, or at least partially. The earnings report was coming up, so a strong result could act as a catalyst to push the price higher. With that, the directional bias was clearly bullish, and the timing was anchored around the earnings release. Next came the tactical question. How would I put this thesis into action? After some consideration, I chose the poor man's covered call, PMCC structure. The long leap call would be the engine of the trade, the main instrument to capture upside if the stock spiked. Why? Because the leap with delta of 85 and above will have a stock-like behavior. The shorter dated calls would act as a risk offsetting layer, helping to cushion the cost if the thesis failed. For this type of setup, I usually look for around 10 to 20% gain on the long call before I consider closing it, and about 2% loss of the total account value on the long call premium as my max pain tolerance. So, by the time I entered this trade, I had a clear thesis, a clear strategy and a defined risk profile. Now let's move into the engagement. My trigger to enter the trade was QCOM crossing and holding above the 22 EMA. On April 20th, the cross looked solid and I decided to pull the trigger. I bought a leap call, strike 100, expiration March 19, 27 for $4,410. That was the long side of the trade. Against that, I sold a short call, strike 155, expiration May 8 for 124. The short call duration was clearly too short to run a classic PMCC effectively because of high gamma exposure, but I wasn't planning to hold it to expiration. My intention was to close the short call within a few days, treating it as a small temporary income layer while the long call did the heavy lifting. Remember, in this setup, the long call is the main weapon. The short calls are just loss cushioning backup in case I'm wrong. Shortly after entry, on April 24th, QCOM had a big spike up, around 9%. That forced me to close the short call for a net loss, but the leap call had also gained value and the trade became profitable. At that point, I decided to close the entire position, locking in $1,040 of profit on the leap. After that, I expected a small pullback. The catalyst was still the earnings report and that hadn't happened yet. So after some analysis, I decided to run the same playbook again around the earnings date. I opened a short naked call over the weekend and then bought a new leap call on Monday with the same 2027 expiration but strike 105. In retrospect, the naked call was unnecessary, but the premium looked too juicy to ignore. I treated it as an extra backup, a way to hedge the downside if the trade imploded. Earnings arrived and the market liked the report. The stock jumped another 10%. I had to close the short call for a net loss, but the leap call was again profitable and I realized $1,544 on that leg. That marked the end of my QCOM campaign. Time to shift to the Exfil. On screen, you'll see the full breakdown of all of my QCOM trades. Total capital deployed in leap call purchases was $9,436. Trading activity across both setups resulted in a net profit of $1,875. That works out to a 19.8% return on deployed capital. For context, my usual target for a single trade is around 3% return on capital, so this one significantly exceeded that benchmark. Looking back, the most capital efficient approach would have been to keep the first slip running through earnings instead of closing it early. But I made a conscious decision to exit when the predefined profit target was hit, and I stayed consistent with my rules. Did I leave some money on the table? Absolutely. But here's the thing. 1. I make mistakes and I learn from them. That is why I keep a journal in form of these videos. And 2. Not following my rules has cost me in the past. I'd rather keep risk small, protect capital, and stay consistent over the long term. To me, that's the real lesson here. Execution is not just about the best case outcome. It's about staying aligned with your book, even when it means walking away with only a slice instead of the whole cake. You know that old saying, to win the game, you have to stay in the game. And with that, we wrap up this episode of Recon Reports. If you found value in this mission, be sure to lock in your support by liking, subscribing, and following our movement. Thanks for standing watch with me today, and until next time, trade smart, risk sharp, stay on target.